Well, good morning and welcome to the Reserve Bank. I didn't realise we had to start press conferences with health and safety warnings. So, with me I've got John McDermott, who you know very well. He's the Assistant Governor and the Chief Economist. So let me just make a brief introductory comment. The Reserve Bank today left the OCR unchanged at 2.25%. Global financial market volatility has abated and the outlook for global growth appears to have stabilised. There has been a modest recovery in commodity prices in recent months. However, the global economy remains weak despite very stimulatory monetary policy, and significant downside risks remain. Domestic activity continues to be supported by strong net immigration, construction, tourism, and accommodative monetary policy. The dairy sector remains a moderating influence, with export prices below break-even levels for most farmers. The exchange rate is higher than appropriate, given New Zealand's low export commodity prices. A lower New Zealand dollar would raise tradables inflation and assist the tradables sector. House price inflation in Auckland and other regions is adding to financial stability concerns. Auckland house prices in particular are at very high levels and additional housing supply is needed. Headline inflation is low, mainly due to low fuel and other import prices, and long-term inflation expectations are well anchored at 2%. After falling in recent quarters, short-term inflation expectations appear to have stabilised. We expect inflation to strengthen, reflecting the accommodative stance of monetary policy, increases in fuel and other commodity prices, an expected depreciation in the New Zealand dollar, and some increase in capacity pressures. Monetary policy will continue to be accommodative. Further policy easing may be required to ensure that future average inflation settles near the middle of the target range, and we will continue to watch closely the emerging flow of economic data. So happy to take questions.
Governor, are you able to give us an idea of how close today's decision was?
In essence, when we looked at the economy and the data, our view was really not much changed from where we had been previously, since the previous OCR decision. So it was a decision which always requires some difficult balances and trade-offs, but we felt comfortable in terms of the strength of the economy, the stabilisation, if you like, in terms of the outlook for the global economy, the fact that oil prices had come up a bit. In fact, they're up to $52 today. And inflation expectations, some of the data seemed to indicate that had stabilised. So we felt confident in terms of the decision we took.
Governor, I understand you have been in discussions with the Finance Minister about macroprudential tools in terms of debt-to-income ratios. Can you tell us where that is at? Are they imminent?
We've had discussions with the Finance Minister on macroprudential tools. We've talked to the Finance Minister and said that we're doing some work on loan-to-value ratios, which the market is familiar with, and that we also wanted to do some work on debt-to-income ratios. We also said that that latter work is likely to take longer, but we'll be probably talking with the Finance Minister, I would expect, in the next few weeks, just in terms of the consultative process that we go through. We'll talk with the Treasury, we'll talk with the Finance Minister and get their perspectives.
So could we expect to see, is it reasonable to think that if you make a decision, would it see it towards the end of this year?
It's possible. It's possible that we would be moving towards the end of the year or before that.
Governor, given that you've indicated that there's going to be probably another cut, what did you see as the major advantage of waiting?
Well, the interest rate projections we put out are always conditional projections, but there is one further cut that's built into there. That could change, of course, because it's dependent upon a number of assumptions about how the economy is performing, what might happen to the exchange rate, what might happen to inflation expectations. So you could end up in a situation where there is, in fact, no cut, or there could be more cuts. But we've built in one. In essence, when we looked at the economy, you've got an economy that's probably growing around 2.5% to 3%, and the forecast that we've got is for 3.25% growth over the next 12 months. We've got the global economy, which has been downgraded by several international bodies in recent quarters. Those downgrades seem to have stopped. Having said that, the World Bank yesterday cut its forecast for global growth. You've seen financial markets become more stable. The volatility that was there in January and February has abated. And if you look at this economy, there's a number of drivers that are supporting growth. You see it in terms of consumption. You've seen some significant real wage increases in the last few years. You've seen strong employment growth. You've seen strong tourism, strong immigration. All of those have added to be a driver of consumption. You're seeing a very significant amount of building taking place in terms of residential building and non-residential building as well. And at the same time, we've seen inflation expectations, which bothered us in March, and that was a major factor why we cut interest rates in March. And we'd seen those stabilise, and you'd seen oil prices pick up, but maybe a bit more inflation pressure starting to come through in the economy. And so for all those reasons, we felt at this stage we don't need further stimulus, monetary stimulus to the economy. And so we decided to keep interest rates unchanged.
Governor, in the MPS it says that you judged that extra stimulus would add volatility to non-tradables and output as one of the reasons why you didn't go. What sort of volatility would we have been looking at?
You know, the thing that we can influence to some degree is what happens to non-tradables inflation. We can influence in the short to medium term through monetary policy and the various transmission mechanisms for it. We can influence the degree of the economy's output gap, if you like, the extent to which there's excess capacity or otherwise in the economy. And you know, if you provided further monetary stimulus at this point, and our judgment is behind these forecasts is that the output gap is basically closed at this stage, then it would have led to further upward pressure on the housing market, and that would presumably have had some impact in spilling over into consumption and aggregate demand in the economy. And we just felt at this stage the economy doesn't need that extra stimulus. But let me ask John if he wants to add anything.
Well, I'll add one point that relates to this question and the previous question is the next monetary policy statement is just around the corner. And before we get there, we'll also have information on the Consumer Price Index and GDP. And so the picture will be a lot clearer at that point. So between now going backwards in March, not that much has changed, but we really have a situation where the option value of waiting is much higher than normal. and the cost of waiting is much lower because the next monetary policy statement is, just a few weeks away.
Governor, could you talk about how much of a factor the concerns about financial stability were in the decision today? Because I note that in the press statement you do point to adding pressures of the house prices on those stability concerns.
Yeah, it's a tricky thing in many respects. Our prime objective under the PTA is to have inflation, consumer price inflation within the 1 to 3% band, and over time to try and move that towards the midpoint of the band. But the PTA also requires us to monitor asset prices. There's specific language on that. It was inserted this time around when it was negotiated with the finance minister. And there's also language in there that requires us to have regard to financial stability. We can, as I said before, we can influence inflation primarily through non-tradables inflation. Like take for example, we've cut 125 basis points since we started this easing cycle. The TWI is basically unchanged since that time, if you take the start point and where we are now. And that's because a whole lot of things, as you know, influence the exchange rate in terms of what happens overseas. We've seen the Bank of Japan ease, we've seen the European Central Bank ease, we've seen a change in exchange and risk sentiment in markets, we've seen commodity prices move. So one of the things that we can influence in a sustained way is non-tradables inflation. And that, depending on how it works its way through the economy, takes us into issues of asset prices and the wealth effects that may come out of those asset prices and how they may affect consumption and spending. So it's something that we have to look at very carefully. We've got an Auckland housing market that now has house price to income ratios of 9 to 1, about 70% above the rest of the country. So in terms of the PTA, which as I say requires us to look at asset prices, requires us to think about financial market stability, have regard to it, it's something that we can't ignore. But let me see if you wanted to add anything, John.
Oh, nothing substantive. I'll add a little factoid, but the very first PTA actually did contain the information or the condition about financial stability. And over time, it sort of fell out and it's been put back in. But it's probably something the bank has always been thinking about. You think, but inflation has the primary goal here in terms of monetary policy, and then you think about how do you achieve that without creating excess volatility in the real economy, and how do you not create any imbalances in financial markets or asset prices. So it's always something good monetary policy will be thinking about.
But has that financial stability concern increased as a factor in your decision making since the last monetary policy statement?
Well, what we've seen is house price inflation in Auckland start to pick up again. We've seen house price inflation in Hamilton, Tauranga, Otago Lakes sort of been in the 20 to 25% range. So there are things that we certainly have to think about. But let me just add one point on that, because I don't want you to get the impression that these decisions are driven solely by financial stability. Our objective is very much in terms of the requirements under the PTA. And if if we felt, in order to meet the PTA requirements, given the strength of the economy, if we felt that we needed to adjust the exchange rate or adjust interest rates to try and move the exchange rate, then we won't hesitate to adjust interest rates if we need to.
Just sticking with the house prices, you raised that as one of the two major risks, the other being the currency to your sort of outlook. To both allay the financial stability concerns and I guess mitigate the risk of excessive house prices in Auckland sort of continuing to create inflationary pressures, do you consider that a correction you'd have to see a correction in prices, i.e. prices to fall, or is a moderation of inflation enough to contain those concerns?
What we worry about around the housing market is the risk to financial stability. That's our prime concern. You've got, as I say, house price to income ratios in Auckland that are very high. Puts Auckland in the top 10 most expensive cities in the world. And you're seeing significant house price inflation in other parts of the country. There seems to be a perspective amongst New Zealanders that house prices will always go up. The last major change in house prices, you saw some adjustment after the global financial crisis, but the main adjustment prior to that was in the 70s, and probably many people missed it because, in fact, real prices fell pretty significantly, but it was hidden, partly because inflation was so high. So nominal prices, didn't move a great deal, but the real reduction was quite significant. But there's just a perspective that house prices will continue to go up. And you look at the leverage in the economy, and that's something that has been a concern to us, and that's why we've introduced loan-to-value ratios. The loan-to-value ratios, while we're on them, we regard as very successful. When we introduced these, there was comment that, well, this won't fix the housing market. And we've always been very clear that the central bank can't fix the housing market. We can influence the price of credit and to some extent the demand for credit and the rate of credit growth in the economy. But there's a whole lot of supply and demand dynamics out there that we can't influence. So when we introduced LVRs, we felt that we could temporarily slow the rate of house price inflation. But the main purpose of the LVRs, and where they have been, in my view, very successful, has been in reducing the risk around the loan portfolios in the banking system. And let me just illustrate. When we introduced LVRs, banks were lending about a third of their lending was going on highly leveraged house lending. And that's why we introduced the 10% limit, knowing that 10% might become 7% as banks tried to stay beneath the limit. If you look at right across the banking system, the proportion of the loan portfolios in terms of housing books that are highly leveraged, in other words, have loan-to-value ratios over 80%. When we introduced LVRs, that was about 21% of the total banking system's loan book. That's now down to 13%. And that's been the equivalent of around $20 billion worth of highly leveraged lending that hasn't taken place. And the effect of that has been to make the bank's loan books safer than what they would have been without these measures. So that's why we're also now in this situation looking at LVRs and saying, is there anything else that we might need to do, particularly given the rapid growth and the volume of transactions that are related to investment properties.
So would moderation be enough to allay some of your concerns around that?
We'd certainly like to see house price inflation slow significantly, no question about that.
Are you signalling that the LVRs could be extended for investors? Is that one thing you're looking at, the 30%, push that up even higher?
It's just one of the scenarios that we're looking at.
And can you
We haven't made, Corin, we haven't made any decisions on that.
So just some clarity on that issue of the next sort of wave of macroprudential tools that are being looked at. What is the message to those in the housing market or those in the economy about how likely that? I mean, where are you at? Do you want to see another tool in place sometime this year? Is that a definite?
I think where we are is we're doing quite a lot of analysis at the moment around loan-to-value ratios and whether they should be modified in some way and perhaps connected into investor properties. We're also doing some work on loan-to-income ratios, debt-to-income ratios, but that's analytical work that's probably going to take quite some time. As you know, we've been collecting debt-to-income data from banks for about a year, from the large banks, but not from the smaller banks.
So the LVR investor bit is the bit that could come sooner.
That's one of the possibilities, yeah.
Governor, the New Zealand dollar has risen at one point over 71 US cents this morning. You commented in the statement about how it was high. What are the chances that you would look at either using intervention or using the OCR itself to get that currency down?
If you look at the turnover in the New Zealand dollar and you look at the last set of figures from the BIS, daily turnover is roughly around 105 billion US dollars a day. Most of that takes place in US New Zealand dollar trades. Most of it takes place offshore. So the ability of any central bank with limited reserves to be able to modify and change the tide in the exchange rate is always going to be limited. But we do have a traffic light system, and at times in the past where we've felt that we've met the conditions that are under that system, and perhaps at times when the price has gapped and there may be limited liquidity in the market, then in those situations it's possible that you may have some influence on the exchange rate. In terms of future interest rate decisions, I mean, we'll just be driven by the data. We'll look at a lot of things. We'll certainly look at the exchange rate. We'll look at the growth in the economy. We'll look at inflation expectations. We'll see what's happening with asset prices. But let me see, John, did you want to add anything?
Well, perhaps the other thought on that is we'll also be looking at the consequences of a high exchange rate on the real economy and on imported costs and what those price changes do to inflation expectations. So it's not something we would ignore.
Yeah, what's also important is what might drive the exchange rate. Is it driven by terms of trade or is it driven by portfolio effects? So that would affect your thinking around it too.
The Policy Targets Agreement says that you look at a midpoint of 2% and a range of 1 to 3%. You've been below the 2% midpoint, according to these forecasts, by the time you get there for 6 years, and 2 years below the bottom end of the range, at least for CPI inflation. Are you meeting your targets on inflation?
I think you have to look at the language in the PTA, and I'd invite you to go back and look at a speech I gave in February where the first half of that speech was focusing specifically on what did the PTA mean, why was there certain language put in there, what did that language imply for the actions of the central bank. If you look at inflation, and headline inflation is low, as you know, and it's low pretty well all over the world. The reason why it's low primarily is because tradables inflation has been negative for the last 3.5 to 4 years. And it's been low because world inflation's been low. It's been low because there's been an excess supply of manufactured goods worldwide, particularly coming out of China and East Asia. The same is true of capital goods. And it's also, the exchange rate has been higher than what we would have wanted. Put all those factors together and you've got negative tradables inflation. That accounts for half of the CPI. We can't influence world inflation, obviously. We can't influence the excess supply of manufactured or capital goods. We have limited impact in a sustainable way on the exchange rate. The thing that we can influence is non-tradables inflation, and that's tended to run between 1.5% and 2.5%. That's the thing that we can have most influence over. And even that's been reduced by about 0.5% because of the ACC charges. Did you want to add anything, John?
It's perhaps worth emphasising that we are a flexible inflation targeter. So there's more to think about than just the CPI. And one of the things that PTA talks about is from time to time there will be deviations, and they may be quite large and they can at times be persistent. But the goal is to get to the target over time so that you protect the real economy, allow it to continue growing if you can, and not unduly, create other imbalances. And so I think, Bernard, your time frame is very short. You mentioned 6 years. If you take the arrangement where the PTA has said the target's between 1 and 3, that average over that longer time frame has been an inflation rate just over 2%. So in the long span of history, I think the bank's probably doing its job, and it's the framework that delivers that, not meeting by meeting, which you can do very little.
How much of an impact are investors having in the housing market at the moment, in particular in Auckland and Hamilton? Do you have numbers on that, and how concerned are you that there appears to have been a bit of a spike in that investor activity in the last few months?
I think from the data I've seen, investors account for about 42% of the transactions in Auckland. It's come up a bit. For the rest of the country, it's still pretty significant. It's around 40%. Now, have we seen some investor activity drive the Hamilton market and the Tauranga market? There is some data on that that I've seen, but I'm not very definitive on it. Certainly there's a lot of anecdotes around to that effect.
Should we be concerned by those levels?
Let me ask Grant that. That's a question for Grant. Is it, are we unusually high in New Zealand? I was in Canada the other day talking with the Governor of the Bank of Canada, and the data he said for Canada, which surprised me, and I haven't looked at it in any detail, but he said that investors he thought accounted for something like 10% of transactions. Now I haven't checked that, but 40%, 42% is quite a significant part of the market. Did you want to add anything, Grant? Or?
Is this working? Mm-hmm. Yeah. Yeah, I think in New Zealand, I think it's safe to say that housing is a larger proportion of household investment than for many other economies, in particular Europe and the US. So we're starting from relatively high base. I think if the investor component was stable, that would be less concerning, but we have seen the share of investor sales increase, particularly in Auckland. And I think that number that Graham mentioned is now up to 46%. So the fact that the share of sales and the share of credit going to the investor segment, I think does indicate that has been adding pressure to the market.
Governor, financial markets have become less sure about what you're going to do on rate decision days. Is that a concern at all, and what's your response to criticism of the bank's communication?
I saw some analysis by a bank recently, and I saw it written up in the paper. So it's worth talking about it for a bit. And let me start off with some of the comments that have taken place around our decision to cut in March. The first half of that speech was mainly talking about the PTA and the flexibility that's built into it, and why certain language was included, and some of that language was included as a result of discussions between the bank and the finance minister at the last PTA agreement. And how did we interpret it? The second, and we wrote that speech because we were concerned that some commentators were out there simply saying, hey, headline inflation's low, you need to keep cutting interest rates, head towards zero like the other central banks in the world. So we wanted to explain the flexibility and how we thought about the PTA. The next part of that speech was then talking about how we're seeing the world. And at that point, we felt that inflation expectations were stable and consistent with the midpoint of the band. And we wrote, we would not wish to see inflation expectations become unstable and decline significantly. Now, 2 weeks after we gave that speech, 2 weeks after we gave it, and before we sat down and did our forecast reviews, we found major changes in the inflation expectation data for 1 year and 2 years. The 2-year data for the median expectation went from 2% to 1.6%. It was a big adjustment. The 1-year data went from 1.6 to 1%. Now that's a big adjustment. If you're a central bank and you're a flexible inflation targeter and you get information like that, you don't ignore it. You think very seriously about it. You start saying, what's driven that? Could it continue? And we've seen several central banks around the world get into a situation of depressed inflation expectations and high debt, and then struggle badly to get out of that situation. So that was the main reason that we cut. And some people in the market got that, like Harbour Asset Management, for example, and others didn't get it. And I believe, and my colleagues believe, that they didn't read the speech carefully enough. Now, there's some other analysis that's been prepared recently by a bank that suggests that the surprise element in monetary policy decisions has increased. The analysis looked at the period from 2012 through to the current period. Now, there's a lot of interest rate stability in that period from 2012, so naturally, when you start making changes in the way you're thinking about monetary policy and the risks in the economy, you're going to be in a situation where there will inevitably be some surprises in the market. Instead of looking at that data from 2012, as the bank did, and you went back, from 2010, and you went back to 2006, and you looked at the Credit Suisse OIS data, then you would find that the surprises in that period from 2006 to 2010 are no different from what they have been in the last several months. What do you conclude from that? Well, what I conclude from it is that periods of changes bring surprises. And that's true for every central bank making interest rate decisions. In recent years, markets have got used to little change and little surprise. And so what we're seeing now is no different to what the data shows if you go back and look at it from 2006 to 2010.
But is it fair to compare this period with the global financial crisis in terms of volatility?
Well, that was my point. If you look at this data from 2010, you've got a period of stability with interest rates. So go and don't compare now with a period of stability where their expectations in financial markets were amongst several central banks that we will see interest rates stable for quite some period. So you go back and look at data where the situation was different, and you find that the surprise element is no different compared to now with that other former period. And the same would be true for other central banks.
Just one further question on communication. The number of speeches, on the record speeches that you and your fellow policymakers give has dropped quite significantly in the last 18 months. Is there a particular reason for that, given that you actually had a stated aim of wanting to increase that sort of communication?
Yes, and no real reason for it. We've got one or two coming up that are in the pipeline. Grant will give one, I think, soon, relatively soon. I'll give one probably around July. It's interesting. I asked a reporter with a business magazine for feedback on the record speeches. I said, "How do you find them?" And the answer we got back was, "Well, they're a bit too complicated and too many ideas." So hopefully they get read. Hopefully they do.
Can I add one thought? It may be true that at this point in time there's less speeches and it could be well be different, but what's also true is the number of bulletin articles, the number of discussion papers, the number of analytic notes has increased massively. So central bank communication is more than speeches. They're important and they're a very useful tool, but we also communicate through other channels.
That's a good point.
Just a question on the 90-day bill forecast, which is unchanged at 2.1% from mid-2017 to mid-2019. Is that what is generated by your inflation models and your modelling, or is that some sort of guidance by the bank? Because I noticed that Treasury's forecasts for the 90-day bills actually show an increase later in that forecast track, even though they're and they also see an increase in inflation.
Bernard, that's probably an interesting point, and it's worth noting that these are our interest rate plans that we think is necessary to get inflation back towards 2% over some reasonable time frame, probably 2 years. And when things change, those interest rate plans will necessarily change. So you should, and because of their very conditional nature, you should think about them as our plans, what we think is necessary, not as pure forecasts. In terms of forecasting performance, because so much can change, they'd probably be very poor.
Governor, just on the market reaction to the announcement today, that Kiwi up, almost descent to about a year high. I think swaps were up a touch as well. Were you expecting that kind of reaction by staying on hold and perhaps waiting until August?
Well, I'm not too surprised by things that happened in financial markets. Going into the decision, I think basically there was about 6 basis points of cut that the market had built in. In other words, something like about a 20 to 25% probability that the RB would cut.
Just one final question, Governor. Have you made a decision yet about whether you will apply for or accept a second term?
Oh, I think I'll pass on that one, Bernard. Well, thanks very much indeed.